Hey everybody, Stephen McManus with Coastal Collective, a local real estate team in Charleston, South Carolina area, servicing anywhere from Somerville down to the islands. The Collective, which is what you're watching right now, is a podcast dedicated towards highlighting local partners, vendors, business owners, coaches, all types of local folks that just enhance our community with a big emphasis on supporting our mission and delivering top tier real estate services. So today I have Gary Harwyn. Gary Harwyn is just an amazing lender. He's one of my best lenders. We're going to get into why in a minute. I'm going to do a quick intro on Gary, if that's cool. Can I read it?
Take your time.
Okay. All right. Today, I've got my guy, Gary Harwyn, on the show. If you've been around Charleston real estate long enough, you know Gary and I have probably done more deals together than we can count. He's the mortgage wizard behind the curtain. 25 years in the game, top 1% in the country, and still somehow answers my calls faster than my own family. No comment. Gary makes sure my clients don't just close, but close with confidence. So first, before we get into it, before we jump into some questions and the topics, tell me a little bit about yourself. What drives you? What motivates you? Why do you love Movement Mortgage? How long you been with them? Did you get all that?
I did, yeah. And of course, I want to know why your family doesn't answer the phone as fast as I do. You know, maybe it's one of those things where you care about your business so much, you know it's a deal, or you know it's a partner calling.
That's it.
You got to race and go get it. So let's hope everybody finds the love in their life where they answer the phone as fast as they do. The same as a lead coming in for a $5 million home in downtown Charleston.
As soon as God places a wife in my life, I will pick up her phone call first and my daughter. But besides that,
I can promise you when that $5 million lead is coming in and my wife's calling, it's
tough.
I'm going to go with Ashley.
You got to go with Ashley.
I promise you. Love you, baby.
You got to go with Ashley. Tell me a little bit about yourself. What drives you? What motivates you?
Well, my family definitely motivates me. My wife, my two beautiful children, that keeps me going. It's my big why, and I keep pushing to always do greater, always be better. So my name is Gary Harwyn. I'm with Movement Mortgage. Been with Movement about 10 years, and I've been lending in Charleston for about 25 years. It's a wonderful, wonderful real estate community. There's so much going on here. I think it's a wonderful market. And one of the things I'm most proud of is the company that I work for. With Movement, we're what's called an impact lender. That means we give back at least 10% of our proceeds from our mortgages back to communities. And Movement takes that a step further, and we give about 50% of our profits that we make from our mortgages back to the Movement Foundation.
Wow.
The foundation is responsible for giving a little over $400 million since over the last 10 years back to communities, not only in the United States, but around the world. And one of the things that Casey Crawford, our CEO, is most passionate about these days is really trying to reform education in the country. The goal is to build 100 schools in the next 10 years. We've got 4 successful schools in Charlotte, North Carolina that are doing great. There's one in Atlanta and one in Raleigh. I think both of those are under construction. And about a year and a half ago, we cut the ribbon in Charleston for Movement School in Charleston. And in the 25 years I've been lending, that was the most proud day I've ever had. Was we cut the ribbon on that school and got to see the families and the kids that was impacting. Because we're going in the areas where there's marginalized children. They just don't have access to the education systems that you have like here in Mount Pleasant and things like that. And we're establishing an education system there that's going to lead them to a much greater outcome of being more successful in life and have good safe, structure inside a wonderful facility. And that's awesome. The Movement School. Just great. It's a wonderful thing that's being done.
So cool to hear.
Yeah.
Being purpose-driven with your business and giving back and being generous. You don't give away like nearly $500 million and have some ulterior motive. That is legitimately just to give back.
Well, it's interesting because you see other mortgage companies, they have names on stadiums and on sports teams. We'd rather have it on a school uniform.
It's amazing.
Than see it on a stadium.
Some people really just actually do it for that reason versus a kickback from the government. It's pretty cool. I love that. So I've got they attract a lot of employees that are more purpose-driven, generous.
A little bit. I think we try to attract talent. It's not something that we lead with necessarily.
Well, I mean, for sure you're attracting talent, but I mean, like those types of people you can still have somebody who's an amazing lender, but also has a philanthropic spirit.
Yeah, we have deep culture. Culture runs deep at Movement.
That's cool. Did you just make that up?
Absolutely not. No, we have a marketing team. Yeah, for sure. Yeah, culture runs deep is sort of one of our little taglines.
All right, so I love it, man. Dude, thank you so much for the intro.
Great to be here.
I love to hear about the purpose, family, and this obviously the company that you represent, that you've worked with for 10 years. That's a good bit of time to work for a lender. 25 years in Charleston. That's amazing.
Thank you.
All right, we're going to talk about 3 topics. 1 is jumbo loans, 2 is DSCR loans, and then 3 is the 50-year mortgage. We're going to hit that quickly at the end. So let's jump right into jumbo. Let's jump into jumbo. All right. Here's a question for you. Jumbo start in the $800,000 range. If you're shopping in the 800-ish million to 4 million range, which is where most of our clients fall into, you've probably heard the term jumbo mortgage. What does that actually mean for buyers in Charleston's luxury market? What makes a jumbo loan different than a regular?
The price point of how much money you're borrowing is what differentiates it. But there's other factors once you get inside of a jumbo loan that are going to differentiate it as far as like underwriting, credit score. There's other parameters come into play. Think of jumbo loans as going into the VIP lounge. It's harder to get into, but there's more perks, meaning you might have a harder time to qualify if your credit scores aren't good, if your reserves aren't adequate, or your debt ratios are too high. You might have a harder time getting through underwriting. But if you can qualify, if you can get in the door, you may get access to better pricing. You might get a better interest rate. You might get better products. You could have access to a 7 or 10-year ARM, which might not be available to a conventional home buyer.
Interest rates, do they typically go up, down?
So interest rates, it kind of depends. Right now, though, if we're comparing conventional to jumbo loan, we're oftentimes seeing better interest rates on jumbo loans.
Okay.
And then specifically, you could take advantage of, let's say, like an adjustable rate mortgage. You can do like a 5, 7, or 10-year ARM and get access to much better pricing than you would on a conventional 30-year fixed.
Okay. And then cash reserves. What kind of cash reserves do clients need to have?
Yes, that's a great thing. So cash reserves typically could be anywhere from 3 months to 6 months, what they call PITI, principal, interest, taxes, and insurance, and association dues. So typically it could be 3 to 6 months. On a larger loan, let's say a $2 million, a $3 million loan, you might need 12 or 18 months reserves. Okay. Other things to be conscious of is your credit score. 700 credit score would be considered good by most, standards. But a 700 or 720 versus a 780 or 800, you're going to get different pricing. Yeah. You might pick up an 1/8 or 1/4% better interest rate if you're in a better pricing tier when it comes to your credit score. So what I oftentimes do is I try to pull the credit report as early as possible in the loan cycle, in the sales process, where if we can look at someone's credit score, maybe it's a 719, I might try to elevate them through the 720, get them up 1 or 2 points, which could get them an extra 1/8 or 1/4 improvement in pricing. So the things you want to look out for on jumbo mortgage would be have a strong down payment, minimum down payment 10%, ideally 20%, because if you're putting down only 10 or 15%, you're usually going to have a higher interest rate because there's risk associated with putting only 10 or 15% down on a jumbo mortgage, on a mortgage that's $1 million or $2 million. So ideally getting to 20%. If that's an investment property, you really want to be 20, 25, or 30 to achieve even better pricing. Okay. So the down payment's important. Having a great credit score is important.
Cash reserves.
Those cash reserves, very important.
All right. So starting the loan application early makes a whole lot of sense here.
Absolutely.
So you can understand exactly what your cash position is. You probably already know what your rate options are. And then just talk a little bit more about starting the application process and what that looks like and why it makes sense to do the application process early on.
Well, I'm a big believer in connecting with a professional as soon as possible. So whether it's me or somebody else, take the advice of your real estate agent and try to get that application started, as soon as possible. I would say ideally 60 to 90 days out. That gives you time to identify really what your budget is, know what your guardrails are in terms of how much you want to spend every month, and come up with a good plan, a good strategy. It's not about finding the lowest interest rate. It's really about finding the best strategy for you. Yeah. And everybody's a little bit different. And I always find it exciting to hear everybody's story. What are you trying to achieve? Because people will come to me and say, well, I thought I needed to put 20% down. And you start looking at their profile and you realize, look, you have a $30,000 car that's costing you $800 a month, 2 credit cards from your wedding, and that's another $30,000. Why don't you put 10% down on the house? We'll increase your mortgage a little bit. It's tax deductible. That $10,000 mortgage increase is going to cost you about $60 a month. Let's take $30,000 or $40,000 instead of putting it on your down payment into the house. You'll never see it again until you sell. Let's pay off your consumer debt. And people are like, oh, that's a great idea. It's a great strategy. Yeah. So really getting an early start allows you to identify things like that. Really start to understand what rates are, how much closing costs you need, because you might want to get with your real estate agent and say, look, we're going to do 5 or 10% down, but we want to get the seller to cover our closing costs.
Right.
Maybe the seller is going to pay for an interest rate buy down, a permanent buy down, or a temporary rate buy down.
Yeah, Gary and I strategize a lot on that because he's going to tell me after syncing with you guys and talking with you about your options, what you need to do in order to maximize your whatever. If you need to reach a certain percentage of seller concessions, you need a certain amount of cash.
Yep.
Because if you have this much cash, if you have a little bit more, then you get this. And like, oh, how do we do that? Well, a lot of lenders don't strategize the way Gary does with, okay, well, he knows the realtor side of it too. to a certain extent of like, okay, well, I know good agents can negotiate in some seller concessions. Seller concessions basically just cash from the seller. So, I mean, there's different ways to do that too. Like the seller doesn't absolutely have to come out of pocket for cash. It can come out of what price point do we go in? They have proceeds coming back to them from when they sell the home. What price point do we go in? Do we go in a little bit lower, higher, blah, 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 blah. So there's a lot of different ways to do this that a good team, a good realtor lender team will be able to identify and execute. So that's huge. What are some use cases or reasons why people would put 30% down?
Get a better interest rate.
Is it simply just for the interest rate? Is there any other?
Get a lower payment.
Obviously, the payment and the interest rate.
Get their debt ratio down.
I'm thinking of opportunity costs. Obviously, that's the big reason I ask is like, do you see it happen a lot, or is there typically normally better opportunity costs for that extra 10%?
I think everybody's different.
Yeah.
I think what's important to know is you don't need 30% down to be a homeowner. Ideally, if you're a first-time home buyer, 5 or 10% is enough.
I just specifically about the 30%. I know there's
30%
been a lot
is going to, I think if we're talking specifically about the number 30%,
specifically
on an investment property, you're going to get a much better interest rate when you're putting 30% down.
Okay. Yeah. Because I've had clients ask me or tell me they're putting 30% down. I'm like, talk to a lender.
Well, it depends. It's like you really want to look and say, what does that extra 10% get you?
Yeah.
Can you take the 10% on a $500,000 loan, $500,000, 10% is $50,000. Where else can you use $50,000 in your life? Do you take $50,000 and putting it towards all your other debt and wipe that out? I'm a big believer in not having any other consumer debt and just having a mortgage payment.
I mean, that's one side of it. But the other side is money market. Where else can you invest it?
Yeah.
So, I mean, maybe it's not the best to put it just in the balance of your note.
People aren't getting rich by paying off their mortgages. They're being rich by monitoring and utilizing their cash in a responsible way.
That's right. And this kind of brings up a topic of the tool set that Movement Mortgage and Gary utilize to show clients comparisons between different loan types. So you have like 15-year, 30-year, 50-year, and we'll get to that in a minute. But like there's also different loan options and loan programs for each one of those 15, 30, whatever. So maybe talk a little bit about that and how you make it easy for clients to make a decision. We're educating them, but like we don't expect you to be a pro. Visibility and transparency is huge. So how do you provide that?
I approach this as a financial consultation, that this is the biggest financial transaction of most people's lives. So therefore, we want to handle it with care, and we want to be very clear and show people options. It's not about getting the best interest rate. It's about getting the best strategy. The clients that I work with, I'm going to present them usually up to four different options, and those are based around their goals. So it could be, look, I don't want to bring that much cash to close, or I want to achieve a special payment. I want to keep my payment low. We're going to come up with the strategies, and I'm going to present those to them in a way that's easy to understand. They're going to get a report that has the options all shown side by side. It's going to show what their total cost is, what their cash to close is, what their monthly payment is, and what their cost is over time. I think the most important element of that is the cost over time.
Yeah.
Okay, because a lot of people aren't able to see that using just a loan estimate. So most people would get a loan estimate from a lender or an online lender or their bank, and it's just going to be a loan estimate. There's no data associated with it other than this is your rate, this is how much money you're borrowing, and these are the costs associated with the transaction. There it is. So my approach, it's more consultative, and they're going to see what the cost is over time. So we can pinpoint in 3 years or 5 years or 7 years, how much interest have you paid? What's your principal reduction going to be? What's the house going to be worth based on 3 or 4% appreciation in the market? Those are things that most people will find to be extremely beneficial in the consultation process, and allows me to have a much more impactful conversation with clients. And that's what really separates me from a lot of other people that are just doing this more transactionally.
Yeah, and I just can't understand why you would not do that when buying a property. It kills me sometimes. I love that you trust your lender, and that's great. And maybe they're going to do an amazing job, and some of them really do. I would not buy a piece of property without analyzing it front and back, looking at what it's going to look like in 5 years. Like, we're talking from a loan perspective, what you've paid off, interest, principal, blah, blah, blah. If you're going to use it as a secondary property at some point and what that does to your taxes, but also from a market appreciation and a forced appreciation perspective, what's the full 360 picture of this property now? But we're looking at this as an investment. So what's it doing in 3, 5, 7 years? Yeah. It's so important to look at that. And a good team will give you that. So that's really cool. And you get visibility to that with these tools that Gary has. And I've seen them. I create an account in the portal when my clients use Gary as a lender. And it's really cool to watch the dials turn in their head and watch them pick something and they're happy about it. And a lot of times, like Gary, we've seen this where there's an obvious first choice, but it doesn't make sense to them. The second best one makes sense to them for whatever reason, but they're happy with that and they pick it and they know full well why. And they know all the options associated, what's on the left of that and what's on the right of that. Yeah. So it's really cool to watch that. I wanted to give that a plug for you and Movement Mortgage. It's made my client's life a lot easier. It's made my life a lot easier. So jumping over to DSCR loans. So DSCR loans, if you've ever hit a wall because your personal income didn't qualify for you for another rental property or a rental property at all, listen up. There's a loan designed for you. The DSCR loan. Gary, you've been helping a lot of investors use this strategy to grow their portfolio fast. Can you just tell me a little bit about what is a DSCR loan and how do you qualify?
Sure. So DSCR loan stands for debt service coverage ratio. And what that means is we're trying to establish a ratio to cover the debt, and the ratio has to be positive. So imagine the debt on your property, the mortgage, the taxes, the insurance cost you $1,000 a month.
Check.
Okay. Then you need to have rent that exceeds the debt. Okay.
$1,001.
$1,001. Now your ratio is 1.01 on that. So we want to look for properties that will have a 1.01 or greater debt coverage ratio. So if it's greater than 1, that's fantastic. And that's all that we care about on these types of loans. Yeah. It's like a business loan. All we care about is the cash flow of the property. We don't care about your income. I don't care if you had no job. I don't care if you wrote off all your business expenses on your tax returns. I just want to know, does the property cash flow?
Can you get a lease for more
Well, we
than
don't even need the lease, but I want to know a couple things. I want to know, do you cash flow on the property? And we're going to look at how you cash flow. Is it long-term rent or short-term rent? Do you have a good credit score? 640, 680, 700 or above? And do you have 20% down or even 50% down? Okay. Those are the 3 elements that you need. So if you're a investor and you have 10 different companies or 3 companies, or you're self-employed and you wrote off a lot of expenses, but you have 20% down, I don't care about your businesses. I don't look at them. If you're someone that has never worked or you just don't want to provide all this information, I don't look at your income. We're going to look at how it cash flows either one of 2 ways. The first way is long-term rent. So long-term rent is identified by looking at an existing lease or through an appraisal, where an appraiser would do what's called a 1007 rental income analysis, and they'll try to establish what the market rent would be long-term. So an appraiser would go out there and say, based on the comparable properties, we believe this home would rent for $7,000 a month. Okay.
So based upon that tool and that analysis,
that's for long-term
rent. They could get approved for a long-term
rent.
Long-term rent.
Now there's another methodology.
Without a lease.
Correct. So there's another methodology, which is short-term rental. Very popular. Airbnb,
STRs.
VRBO. Those are very popular these days. So there's going to be a higher monthly income associated with those. Yeah. So the problem with the STR, short-term rental, is that data isn't readily available in the marketplace. So appraisers don't have access to that data in the MLS. The only ways for them to find that data is typically going to rental management companies and trying to determine what the cash flow is from other surrounding properties. It's a lot harder for these appraisers to do their job. Now we have a tool that allows us to bypass doing an appraisal for rental income on these properties. We'll use what's called AirDNA, which is a software algorithm that basically tells us, based on data, what they think it's going to be.
I love that.
And we'll use 80% of the AirDNA for a property. So we can type in the address. Our team will run a report and it'll say, we believe it's going to be $80,000 a year.
Yeah.
Take 80,000 divided by 12. That's our number. And we use 80% of that, which means we don't have to do an appraisal for the rental income, which eliminates a big fail point of these properties.
Huge. Yeah. And I can tell you from experience, property management companies do not want to give you anything. They don't give realtors.
I would say more the appraisers have a hard time, doing their job of trying to track those people down.
Yeah. Yeah. But, well, I mean, I'm sure appraisers will have a lot more success with property management companies, but they do not want to just give you rental data.
So the other cool thing about the DSCR loan is the rates are oftentimes better than conventional investment products. So if you compare a DSCR loan, it's easier, less paperwork, and that loan might have a better interest rate than a conventional investment property loan, because Fannie Mae, Freddie Mac have what's called LLPAs, loan level pricing adjustments, which means on an investment property, you might have a 1 or 2 point hit to an interest rate. And on the DSCR loans, because these are our loans, we portfolio them, we don't have those pricing hits.
So they're not looking at your income or the borrower's income, and the rates can be better.
Correct. So show me 20% down and a property that cash flows and a decent credit score, and we could do these all day and help a borrower build an investment portfolio and help build wealth through real estate.
That's awesome. I love to hear that.
Yeah.
And I've had a lot of clients use these. I have one closing on one very soon, within a couple of weeks. They exist. I've done them with, not as a lender, but as an agent. And my clients have had wild success with them. My question to you is, once you've bought a few, how do you keep the momentum going?
Well, you want to get 20% down, and you can do that by just saving the cash from your cash flow. Or perhaps you bought a property that's appreciated in value. You can do a DSCR cash out refinance.
Okay, that's where I'm getting at.
And raise capital from an existing property.
How do you use yes, exactly.
So you can do an 80% DSCR loan and take the equity out of an existing investment property. And again, we don't need to look at your income.
That's right. So that's sort of the momentum piece that I'm talking about is you can use the cash flow from a property you just got the DSCR loan on, your first one, if it's really financially healthy, obviously, and then add in the factor of time to accumulate that 20% down for the next property.
Yep.
And guys, like you can start in the $100,000 to $200,000 range. You don't have to go after an Isle of Palms home. That's the goal after, 10, 20. But yeah, keeping the momentum up, getting that 20% interest rate, and then making sure it cash flows. And really, you want to contact a lender. This is not a plug, but you really do want to contact a lender to make sure that cash flows. You have the tools that
you want to contact Gary Harwyn, specifically the lender.
There you go. That's the plug.
Yeah.
So the tools that you guys have really is a game changer, just to make sure. You said Air DNA and
it's not just the tools, it's also knowing how to use the tools. So experience matters.
Yeah, Gary loves the plug. I love it.
One important element though about the DSCR loan is it's not for primary residence. It's only for investment properties.
Right. So your 6% tax rate as a secondary / investment property kicks in, which is about triple. The taxes you pay in your primary 4% still isn't anything close to the Northeast, guys. So a lot of my clients are from the Northeast or from California. But yeah, you got to consider that. And again, the numbers associated with the deal is something that you and I will discuss and you and Gary will discuss. And as a team, there's checks and balances to make sure that this is the right one for you before you go and sign all the paperwork and we put in anything else on DSCR loans.
It's a great loan product to help build an investment portfolio.
It is. All right, cool. So let's hit the very last topic, which is being talked about right now everywhere on the news, social media, and it's in our world a big topic. We don't really know everything about it yet, but 50-year mortgages, what's the good, bad, and the ugly?
It is a path to homeownership, but I don't think it's the right path for everybody. I think it's an opportunity that people need to consider with great caution. We have a lot of products out there. The 50-year mortgage is probably a pretty dangerous one, just because of the amount of interest that you're going to pay compared to a 30-year, which is, if you start looking at the math around these things, the amount of interest that you pay on a 15-year loan is about 50% of the initial principal. So if you borrow $100,000, you're actually going to be paying about $150,000 over the life of that mortgage. Now, a 30-year fixed, you're going to be doubling that. So you're probably paying 100% on that. The 50-year, if you do the math on it, it's like 225%. Okay. Now, the fact that you're not building equity is important to understand that. But there's also about 1.5 million people out there that already have interest-only loans. Those are very specific financial products that were introduced to hopefully people that were educated about it and using it for cash flow. I think there's an application case for this 50-year product, but I don't think they should be as commonplace as the 30-year. I don't think it's the right solution for affordability, but I think if it helps bridge a gap between someone that's in an apartment, renting, and needing to get into the home, and that's the best path forward with great caution and with great consultation, perhaps that's a product that could be leveraged.
And you could pay it off as though you have a 30-year mortgage.
Yeah, and maybe it's, look, let's have a consultation about that this is allowing you to get into this home, but pay on that 50 like it's a 30, like it's a 15.
If you're commission-based, you know, when you get a big check, put more into it. Like figure out how to make this, because again, like the tool we talked about earlier, where you look at the loan program side by side, you're going to see it. It's a point in time right now. Right now, the loan balance is $500,000 for all of these different options. Here's your payment for all of these different options. Here's your interest rate for all of these different options. Now, in 5 years, what does your balance look like for all of these different options?
Yeah, people aren't always looking where they're going to be in 5 years. I think the average time in the home for most people is like 7 years. So you want to know where you're at in that 7 years. Again, I think it's a great application for the right person with the right consultation. So with transparency, with education, with deep analysis of that mortgage product, it could be the right product for somebody, but be very cautious of the amount of interest you're going to pay on that.
Yeah. We don't know everything about it yet. We'll see what happens when more information comes out.
What I'd like to see is, supply demand, shift a little bit and create affordability by having, more inventory available.
Yeah. It's interesting to think about a 50-year mortgage. So
maybe insurance prices come down a little bit.
How should people contact you if they're like, okay, cool.
Sure.
I'm seeing this now, and
Yep.
I've been thinking about, have an idea in mind of what I want to buy or where I want to buy.
Yeah.
But I want to know more about the lending process before I contact a realtor, before I even think about like falling in love with a home. How do they find you? What's the process?
So the best thing to do would be to just call me on my cell phone, which is 843-224-5619. I'll usually pick up the phone
Pretty quickly.
You can text me, let them know you found me through Steven. And you can also go to www.mylendergary.com and you can find me there. And
Love that.
That's my website. You can also find me a little bit on Facebook and Instagram and places like that. And you can also get in touch with your great agent, Stephen McManus.
And when they first contact you, what can they expect?
A consultation. So we usually start with a
What's that mean?
5, 10, 15, 20 minute, 30-minute consultation. I usually start out with tell me where you're at, what you're trying to do.
What are you trying to do? Yeah.
What are your goals? Ask the right questions and people will give you the right answers.
Here's what I want to do.
Tell me your story.
Where are you at? Here's what I want to do. And then
We listen.
Yeah.
I try to identify if there's any red flags or cautions. Tell me what you have going on. What are you trying to achieve? Everybody's story is a little bit different. That introductory call will reveal a lot of information. Based on that, we'll usually build a little rapport, have some dialogue. And then the next step is really to go to www.mylendergary.com and apply and complete the application online. That way I can see everything. We have something called the Easy app. You'll enter your basic information. Then I can see all your information. Then the next call is really a lot of fun because then we get to go into what I'm seeing, your credit, your income. We start to establish budget. What are the interest rates doing? What are closing costs? So on that second call, we'll really get into a lot of stuff. And then from there, look, you got your ticket to go out with your real estate agent, with Steven, and go find a home. And then you call me up and say, we found something. Great. We're ready to go. We're all prepared.
Yep. Then we strategize together and figure out how to go into that negotiation with confidence on what you need. Do you need closing costs? So how do we structure that deal? You don't have to have a ton of cash. You really don't, because we could really, again, offset the price point, ask for seller concessions, figure that out. But I would encourage you, when you do reach out to Gary or myself, you tell us where you want to be. Like, what are you looking for in the near term? What are you looking for in the long term? Because I've had clients who are on their third, fourth home with me because they want to live on Isle of Palms one day. Did they start off with a $5 million property? No. Are they getting closer? Yes. What do you ultimately want? This is your time to let your vision come to life, dream, and tell us what you want ultimately. If you want something simple, like you want, to live on an acre property in Somerville and that's what you want because that's peace to you, perfect. If you want to be a big time investor and you want 30 properties one day, tell us that, because that helps us put ourselves in your shoes and formulate Gary's favorite word, which is strategy. And from there, we can take care of you much better. So last thing is, I want to talk about condos. So Gary and I's professional relationship started off with condos. And so I always think of Gary with condos. He's done other deals for me as well, but I always think of Gary when I think of condos. So can you talk a little bit about why you and Movement Mortgage are best suited for helping folks purchase a condo?
Yeah, I love to do condos. And I love to do condos because we have a dedicated condo team. We're one of the only companies that I know of that has a dedicated condo team in-house. Yeah. That means we have staff managers. That's all they do is look at condos. We have a staff attorney. That's all they do is look at condos. We can get projects approved that other people can't. We know how these condos need to get approved, and not every condo is going to get approved. So many of these are what we call non-warrantable, which means they don't fit the guidelines of Fannie Mae, Freddie Mac. It could be something as small as a assessment issue. It could be lack of reserves. It could be construction-related litigation. Our team and myself know how to navigate these things.
You mentioned certain loan programs and types, right? That are non-warrantable.
Requires you to get, if a veteran buying a condo, the condo project itself has to be VA approved.
Right.
That's not always easy to do.
So
Same with FHA.
Blow that open, because I butchered it. Can you blow that open a little bit more? Like, some condos are not warrantable, or talk about that. VA, Freddie Mac.
The way I approach lending with people is, look, we're going to get you approved, but if you're buying a condo, we have to get the condo approved too. And not every condo project meets eligibility requirements for either FHA, VA, or conventional or jumbo. Okay.
That's what I was trying to drive home is, you might be really healthy financially and you might be a great candidate as a buyer, but certain loan programs do not even allow you to buy specific condos.
Yes.
And so how do you go about that process, clearing the condo?
Yeah, the first thing we want to do is determine if the condo is eligible for financing. So the way to do that is we get some information about the condo. We want to know who the HOA management company is, what their contact info is. Then we're going to send them a condo questionnaire to be completed. We're going to get the master insurance policy, the master deed, and the budget. And our condo team will take a look at that and determine if the property is either warrantable or non-warrantable. Warrantable means it's lendable. Non-warrantable means it's non-lendable. Yeah. Doesn't meet the guidelines for financing.
For specific loan programs.
Correct.
Or any. But
so when you hear condo, you really need to find out, is this project warrantable? And we have to determine that. And as a smart lender, you want to get in front of that. And as a smart real estate agent, you want to work with somebody that's experienced in condos.
Exactly.
Or even better, that has a dedicated condo team. Just stay in front of it. Don't wait until after the appraisal, after underwriting. You don't want the condo to be the last thing you look at.
Well, I look
at
at
your
it
condo, it's like that should be the first thing you're looking at.
Right. If you're a buyer looking for a condo, stop looking for a condo until you've connected with a lender, because if you're falling in love with a condo and doing showings and you want to go put an offer in, it might not be warrantable. Yep. It might not be lendable.
And we've got a list of projects that are already approved by Movement.
Project is
the name of the community that you're buying in. So if you're buying, like I'm buying at the Oaks at Riverland, whatever that may be, that's the name of the project. That's the project that needs to get approved.
Yeah. The main thing with a condo is they're wildly complex.
You got to just recognize that some of these may not pass lendability requirement.
That was the main thing I wanted to talk about. Condos are awesome to own for many, many reasons.
Turnkey.
They're turnkey. You're not cutting grass. You're not maintaining anything. And they're pretty easy to rent out too. So
you got to watch out, because a lot of them, you can't do less than 30-day rentals and things like that.
You can't do SCRs almost anywhere in Charleston anymore. But so you want to make sure you get with the HOA and understand what the guidelines are for rentability. But that's something we always clear. Yeah. There's never a condo I close where we don't clear that with the HOA. So cool, Gary. Thank you, brother.
My pleasure.
I want to thank you for coming on the Collective. Anything else you want to leave with the listeners of the Collective?
I appreciate you, man. Appreciate you having me.
I appreciate you. Thanks for what you do for my clients, for making it easy for them, for giving them a red carpet experience, making them raving fans of Coastal Collective and of Movement Mortgage. So appreciate you coming on, brother. Guys, look out for future episodes of the Collective. If you would like to be on the Collective, please give me a shout. I'd love to talk with you and see if you're a good candidate, and just continue to give us some likes.
They do subscribe, right? Subscribe.
If there's a place to subscribe. I don't know where this goes.
Hit the like button.
We'll see you next time. Thank you.
Thank y'all.